In this video, we will introduce the topic of financial ratios, including the purpose of this form of analysis, the common uses, the different types of ratios that exist, with the corresponding formulas and analysis. Let's begin by identifying the purpose of financial ratios. They are used by stakeholders, which is a broad term for anyone that may take an interest in a particular business, to analyze the financial strengths and weaknesses of that business. Once the financial ratios have been calculated, the application of these results will allow for comparisons with historic performance to evaluate the company's own progress. The results can also be compared with the results of competitors within the industry, which will enable stakeholders to identify the company's financial competitiveness at a glance. The ratios can also be compared with industry averages, which are the benchmark or the standard that companies within the industry should be attaining at a minimum. It is also worth noting the common misconception regarding financial ratios. The results from the financial ratio calculations offer a snapshot of the company's financial performance. However, the real cause needs to be investigated. Therefore, the results should not be taken at face value when making decisions, but rather as a guide to highlight functions that are performing well and functions that are performing poorly, to then be able to ask the questions to investigate the reasons or causes. Profitability ratios, as the title suggests, are ratios in assessment of profits. The first ratio considered is the gross profit margin, which assesses the return after considering trading costs in comparison with revenue achieved. The higher the ratio achieved, the better. This is a basic interpretation of profitability, as you'll see from the next ratio. The second ratio considers the return on sales, which is also known as the operating profit margin. This ratio assesses the return after deducting operational expenses from the gross profit. You could interpret this as phase 2 of the gross profit margin. Like the gross profit margin, the higher this ratio is, the better it is for the business. Finally, we have the return on capital employed, which considers the operating profit achieved against the capital employed. This is a common indicator for shareholders to analyze and interpret, as they are interested in seeing a return on their investment. The higher this ratio is, the better it is for the business, and the shareholders are kept happy knowing their equity investments have been put to good use. Liquidity ratios interpret a company's ability to meet short-term obligations. Hence, current assets and current liabilities are the main workings here. The first ratio is the current ratio or working capital ratio, which looks at the short-term liabilities in comparison to the current cash position of the company. The target level is 2 to 1, i.e. for every $2 worth of net current assets, there is a corresponding $1 of current liability. It is better to have a higher current ratio, but if it is too high, then this may signal that the company is using cash resources heavily and potentially unnecessarily. The second ratio is the acid test or quick ratio, which is also described as the liquid capital ratio. In this ratio, the short-term liabilities are interpreted with the current cash position after eliminating the value of inventories, as these can take longer to turn over to cash value. You could think of this as phase 2 of the current ratio, as it is the same with the exception of the inventories. The ideal ratio is 1 to 1, i.e. for every $1 worth of net current assets less inventories, there is a corresponding $1 of current liabilities. Both of these ratios are indicators but are recommended to be used together with the assessment of the company's cash flows in order to get a better understanding of the liquidity of the company. The efficiency ratios consider how efficiently a company is managing the use of their assets to generate sales or cash. The first ratio here is the inventory turnover days. This ratio determines the number of days that stock is held before it is sold. Low inventory turnover is ideal, as this suggests that less cash is tied up in inventories and can therefore improve a company's cash flow position. A high turnover may indicate inventories are being kept for a long period and not being sold, which may eventually lead to outdated or obsolete stock which might not be sold, as its commercial value in the market will have deteriorated over time. The supermarket industry tends to have high inventory turnover. However, this is deemed normal as supermarkets tend to overstock on a number of goods, as sales are generally very high. Therefore, be careful to consider the industry before making a judgment. The second ratio is the receivable days. This ratio interprets the duration before repayment from their debtors or trade receivables for for sales made to them on credit. High receivable days is not good for cash flow because this indicates that debtors are taking too long to repay the company. This also suggests there are potential inefficiencies in the credit control or debt collecting process. The ideal ratio is approximately 30 days before receiving repayment from receivables. The third ratio is the payables days. This ratio interprets the duration taken by the company to repay purchases on credit to their creditors or trade payables. It is better for the company's cash flow to have a higher trade payable repayment, but it is not good for their supplier relations. Therefore, a balance should be maintained, and commonly the ideal ratio is approximately 30 days to repay payables for purchases made on credit. Next, we will look at gearing. This type of ratio assesses a company's long-term debt finance. The key ratio here is the capital gearing ratio. There are two variations of the formula. The first variation considers long-term debt to equity as a percentage. The second variation considers the long-term debt to equity plus long-term debt. This ratio interprets a company's long-term debt position against the total equity. A higher percentage for gearing will suggest that a company has significant long-term borrowings which they owe, which might not be good for long-term cash flows depending on the industry. A lower gearing ratio is therefore preferred. The second ratio is the interest cover ratio, which considers the operating profit against finance costs. This ratio identifies the number of times that operating profit exceeds the borrowing costs. An ideal ratio is 4:1, i.e., for every $4 worth of operating profit, there is a corresponding $1 worth of finance costs. A higher ratio is preferred here to indicate a company's financial stability to cover borrowing costs. To summarize this video, financial ratios are a tool to examine a snapshot view of a company's financial position. These results are then used for comparison with historic performance and comparison with rivals in the industry, in addition to industry benchmarks to identify overall performance compared with the industry averages. We have looked at the key types of financial ratios, which include profitability, liquidity, efficiency, and gearing. It is important to understand that the analysis of financial ratios is just one perspective, and therefore further investigations are required to make better decisions. Profitability ratios look at the company's efficiency in generating profits. Liquidity ratios interpret the company's ability to meet short-term debt. Efficiency ratios determine the company's ability to use their assets effectively to generate sales or cash. Gearing ratios interpret the company's assessment of long-term debt finance to the owner's equity. It is good practice to note down the ratio formula before doing your calculation workings, so the market can give you credit for your workings even if your end figure is incorrect. Okay, so that's the end of this video. If you found this video useful or informative, please leave a like, comment for any feedback, topic suggestions or questions, and please remember to subscribe for more breakdowns on accounting topics. Thank you for watching.